Hi, I'm Adam Patty. I'm the CEO of VistaShares. Hope you guys are all having a great experience here at GTE. Just going to take a minute and then introduce our main attraction, our main speaker. About a year ago, I was here introducing John at the last GTE last December. We had just launched our first ETF, ticker symbol AIS. We had $500,000 in total assets under management. A year later, we have 7 ETFs. We're almost $1 billion in assets. So we're really fortunate that the RIA community has really embraced our strategies. So thank you very much for that. VistaShares focuses on two main families of products. One is our supercycle growth equity ETFs, which John is going to talk about. Our second is our target 15 options income strategies, which allow you to invest like a legend, but with 15% annual income paid monthly. We focus on creating portfolios around Buffett, Ackman, and Druckenmiller for those strategies. So what differentiates us is really two things. First is the institutional quality we bring to creating our strategies, led by our chief investment strategist, Professor Robert Whitelaw, who is the former dean of the NYU Stern School of Business. And the other way we differentiate ourselves, particularly important in our growth equity strategies where we're focused on disruptive technologies, is having an investment committee made up of people who are experts in the specific areas in which we're investing. When you're investing in places like AI or electrification and robotics, you need people who really understand what's going on in those industries. And we're really, fortunate to have people like Sunny Madra, the president of Grok, one of the top AI companies in the world, Justin Lopas, the chief operating officer and co-founder of Base Power, one of the leading experts in energy technologies, both of whom are on our investment committee. But the leader of our investment committee and the co-founder of VistaShares is John McNeill. John has an incredible background, which I can't possibly do justice to in the short amount of time that I have. John is not only the co-founder of VistaShares, but he's the co-founder and CEO of DVX Ventures. He's the former president of Tesla, former chief operating officer of Lyft, currently on the board of General Motors, Lululemon, and others. He's also the vice chairman of the autonomous vehicle subsidiary of General Motors and on a variety of advisory boards related to disruptive technologies. He is widely known as a luminary and thought leader globally in some of these technologies like AI and autonomous vehicles, electrification. And he's going to talk today about supercycles and how we approach that from an investment perspective. So, John, come on up.
All right, this is gonna be kind of fun because usually I'm talking to people before lunch. Hey, you're actually eating. We don't have to worry about that delay. I think what we're gonna do is we're gonna make this as interactive as we can. So I'm gonna give a little bit background on the topic. Adam's gonna do a little of that too, and then we're gonna open it up for Q&A and really talk about maybe some of the things you want to talk about. But maybe the best way to get this topic kicked off is with a story of how this kind of came about. I was asked to come. Oftentimes I get pinged by Andrew Ross Sorkin on CNBC, and he'll text and he'll say, "What are you thinking about right now? What's interesting to you?" He does this with, I think, a lot of people. It helps him generate content and ideas. So I said, Andrew, what I'm thinking about is super cycles because um, typically, as an investor, you get one in your life. If you happen to be lucky enough to be alive in the late 1800s, you got the Industrial Revolution. You got one super cycle. You had to wait 100 years for the internet super cycle to start. Then you had to wait another 30 years for the mobile super cycle to start. And just 15 years later, now we have AI, electrification, robotics, space and defense, biotech. It's all kind of like converging at once. So I wrote Andrew and said, "Hey, look, there are at least 5 super cycles happening right now." And so he said, "Oh, come on CNBC and talk about it." So this was early on a morning on the Squawk Box. We're talking about super cycles, and then the cameras go off, And Kernan and Sorkin turned to me and say, "How do I invest in this?" And I said, "I'm sure you guys, they're thematic ETFs. Let me take a look. I'll shoot you some ideas." So I get in the car to go across town uh, back to our offices. And the first thematic ETF I open is the largest EV, electric vehicle ETF. And the top 5 holdings in that ETF are Amazon, Google, Microsoft, NVIDIA, and Apple. So I look at that and have a reaction that I'm seeing on some of your faces. That's the Mag 7. It's also a 65% overlap with the market cap of the S&P 500. So my first reaction is somebody is fooling investors into paying 75 bips for something they could pay single-digit bips for. First off, that's not cool. Second is, my second reaction, I know a little something about what goes into EVs. There's no Amazon in an EV. There's no Microsoft in an EV. There's no NVIDIA in an EV. We can't put a $20,000 chip in an EV. There's no Apple and Google, believe it or not, because they give away their infotainment systems for free for exposure on the dashboard. So the top 5 holdings in an EV ETF have nothing to do with the profit pools in that industry. So I texted Sorkin back. I said, "Don't invest in these. These are really bad products. I have another idea." And the idea that dawned on me was, why don't you take the market share the bill of materials for different super cycles, which exposes the profit pools, and why don't you weight a ETF based on that? Now, the work we do, you can imagine, like with the Tesla mindset, you're always questioning first principles. And the first principle we started to question was, do you have to build an ETF based on market cap weightings? 100% of ETFs have been built that way since the inception. What we're really good at, and what people crazy enough to work in Musk's environment are really good at, is number one, questioning base assumptions. Can you re-land a rocket? Can you fuse a fuselage of titanium without welding it? Can you have a car that will drive itself? Like, those kind of questions drive you to a very different place that typical industry people are going. So I saw an opportunity to do that in ETFs. So from that car, I called a guy who used to run manufacturing for us at Tesla. He now is in a new job, and that was building out the AI data centers for Google. And I said to him, "JP, can you send me the build sheet for an AI data center?" He said, "Sure, why?" I said, "I have a feeling that 80% of your dollars aren't going to NVIDIA." He said, "Exactly. No, it's like 7%. I said, "What else is in there?" He said, "Oh, cooling, power electronics, substrates, networking software, fiber." And so he sent me over the build sheet for an AI data center with each category of input in each outlay for that category. So we had spend by category. What's interesting in this approach is, you now know there are $500 billion of signed contracts to build AI data centers. We were essentially looking at the purchase orders that were going to be the next order effect. So we know where the money's going. And the idea was, could we create an ETF that exposed everyday investors to those profit pools? And as we mapped those categories across the public stocks, what we found was roughly 60 public stocks make up the materials that go into an AI data center. So if you're going to have an AI infrastructure ETF, that's a pretty good thing to know. Turns out that half of those stocks are domestic and half are international. Why? Well, because our news is dominated by what's happening with U.S. hyperscalers. But guess what? There are hyperscalers outside of the U.S. as well. This is an international business in a marketplace, and it's an arms race between countries. So Saudi Arabia buys a whole set of gear outside of U.S. suppliers. China buys a whole set of gear outside of U.S. suppliers. A lot of those suppliers happen to be based in Europe and Asia. So we created an index. We launched this index in-house, as you do, and we back-tested it, and it blew away all the sector thematic ETFs on performance, no matter what period you looked at. 1 year, 3 year, 5 years, 6 months, 3 months, etc. So as Adam mentioned, we launched this fund uh, December 4th last year. So we just had our 1-year anniversary. It is year to date the number one performing AI infrastructure ETF on the market. It's ticker AIS if you want to look at it and look at its performance. And you can weight that against ARK, anybody else in the space. And so what what we've now sought out to do is take this approach, non-market cap weighted, profit pool weighted ETFs, and expose other supercycle profit pools. As Adam mentioned, electrification, robotics, etc., to give everyday investors access to these, what are, quite frankly, more sophisticated hedge fund strategies. So that's the story of what we created and how we created it. I'm going to buzz through some slides real quickly that are on your tables, but I won't spend much time here because I think maybe our discussion might be more interesting than this. So, the definition of a super cycle is that you've got these trillion-dollar demand surges that are triggered by a technological foundation shift. So if you want to talk about like where we are in this cycle, I think we're in like the third pitch of the first inning, the top of the first inning. This will be multi-decade. Some of you I can tell are as old as me, and I remember when I first started to play with the internet in 1992. And 33 years later, that trend is still going strong and creating a lot of wealth. So we feel like there are as I mentioned, there are multiple super cycles happening simultaneously right now, and most of the thematic funds have a significant overlap with the S&P 500. So they're not adding any value to investors. And what we wanted to do was replace this approach. And if you just look at the investment cycles here in terms of productivity increases, this is why there's so much focus on AI. Believe it or not, this is going to have more impact on our society than railroads and electricity. That is why there's such capital flowing at this point. The first thing that creates is a constraint around power, and you've all heard about that. We can talk about that, and that's appropriate. But what the hyperscalers are doing is they're sidestepping regulators. And the way that they do that is they're putting AI data centers in places with low regulation and low barriers. You buy several thousand acres of farmland in Indiana, that's liquid. If you're Meta, you put up an AI data center and you buy several other thousand acres and you put up solar panels because that's instant power. Doesn't need to be permitted, no grid additions, you get it instantly. So this is the first move that's happening. And despite the headlines, the biggest power increases right now are coming from renewables because it's the thing you can get online immediately. So as an investor, you want to know that, right? I mean, GE Vernova is sold out for 2 years, 3 years. So what are you going to do if you need power? You can't go to GE Vernova at any price. They're sold out. So you go to renewables. And the second thing this is creating is an insatiable demand for compute. And one of the insights that we get out of the investment committee that Adam talked about was we're talking to real practitioners who are building these data centers today. And we say, what is shifting? And we hear things like, if you think the power is constrained, look at memory chips. And we go look at memory chips. You'll see our biggest weighting in the fund is SK Hynix. That is the world's leading provider of memory chips. That allows these GPUs to actually run at fast speeds. And so we're looking at not only that there's an insatiable demand for compute, but it's not just NVIDIA. It's other stocks. So we've got this AI supercycle that's driving an electrification supercycle. The electrification supercycle has two inputs beyond AI, believe it or not, that are driving demand for power. Anybody know what those are? Anybody put a heat pump in recently? Heat pumps and EVs. So if every U.S. household put either a heat pump or an EV online, the grid would be 50% undercapacitized. That's the kind of impact that those two technologies are having on grid demand. So it's not just AI. So then we leg over into the electrification infrastructure and say, what's the constraint there? Where should we be looking to invest? Where are people looking to invest? And it turns out the transmission is the main constraint. That transformer box at the end of your block up on the pole, really simple device, not even containing rare earths. We can't make enough of those right now. That's the constraint in the system. So wouldn't you like to know that? And wouldn't you like to be investing in power transformers? Old school technology made by a handful of companies. So we've got a bunch of stuff happening that's in energy. It's in your deck, and how important power is, and the capex that's going to go drive that into the electrification area. And you see, like, it's not only inside the data center; it's all the stuff outside of the data center, which is something that one of our advisory board members talks about a lot. He, along with Zach Dell, Michael Dell's son, have formed Base Power. They've raised several $billions to address this last mile problem. And so as we stack this up, I mentioned, we've as of the publication of this slide last week, we were up 53% this year with this approach in AI infrastructure. We've got 64% annual international exposure, but only 20% overlap with thematic ETFs in this sector. It shows you how either we're really wrong or they're really wrong. Somebody's wrong because there isn't much overlap here between the stocks that are being covered. And you see some of the holdings here, stuff that companies you probably heard of and companies you may not have heard of. But who would have guessed that Foxconn was providing a number of the components that are coming in here? If you looked at just down 6 through 10, provides an AI data center is twice the fiber as a regular data center. You know who provides that? 200-year-old Corning out of New York. Do you know who provides the power electronics that takes the direct current energy and turns it into alternative current to go into the data center, the power electronics boxes? ABB out of Switzerland. So you get a bunch of stocks that you don't hear about in the news, you don't see focused on in the analyst reports, buy side or sell side, but these stocks are benefiting from the demand that's being created. So we've got a electrification supercycle fund that trades under the ticker POW, and it includes all the entire electrification system that's being pushed. And basically is as I've tried to describe, we are not market cap weighting these. We are weighting these based on the exposure to the profit pool. And we believe this is a very disruptive thing. We've patented it. But the good news is I don't think we need to patent it. The ETF industry doesn't want to follow us because they believe the only way to do this is market cap weighted, and we're glad to have them continue to think that. So this is a snippet of our investment committee and a little bit of the story of AIS. Adam, did you want to talk about Omaha, or do you want to go right to Q&A? All right. Should we go to Q&A? All right, cool. So why don't we do this? This is a little bit Silicon Valley style. So basically, anytime you have a room full of people in Silicon Valley, you want to hear from the people that are in the room. And we always wanted to hear from our engineers, and we wanted to hear from frontline employees. So we do an all hands every week. Believe it or not, was the old Silicon Valley. Now it's typically every 2 weeks. But we'll try to replicate that here. So this is a Chatham House rules environment. You can ask anything. If I can't answer it, I won't. But you can ask anything. And we'll just try to get a discussion going about kind of what's interesting to you in this, with this approach, with electrification, with autonomy, with AI, et cetera. And anything you want to talk about from the circular investment concerns that are going around to anything else. Anybody want to get us started just with a quick question or hand raise? Yeah, right here. Do I believe in SMRs? Do you want to expand on that a little bit? All right. So small nuclear reactors are about 4.5 to 6 years away. And that's why you see companies like Microsoft saying, we're just going to pony up next to a big nuclear reactor, which is 3 Mile Island, because we can get that online sooner than we can get small nuclear. And small nuclear is, I think, going to be a story of the mid-2030s and beyond. It's going to be amazing for grid. But we're just constructing the very first one in Virginia right now, and it'll come online sometime in either in late '26 or '27. So it's not a near-term thing, but I really do believe in the technology for the long run. It's clean, it's renewable, it's now manageable. A lot had happened between 3 Mile Island and now that the US just sort of hit a pause on, and now we're, like, catching up with what the rest of the world is doing. You may read that, China has 50 nuclear reactors under construction right now, and it's because they don't wanna be dependent on oil, from somebody else, over the long run. So they're really pouring into this technology too and advancing it a ton. Yeah, yeah.
It's kind of a chicken and egg question. If we're building all the data centers and they're really needing all the energy, but we're 5, 7 years away from getting a lot of that online, when does the profit start to show up for a lot of these companies?
It's a really good question, and I think the profit shows up based on the business model. And so there's a piece today, I think it was in the Journal, about a very profitable company called Cohere, and comparing their to the OpenAI business model. So what Cohere has done is Cohere has said there's a different approach to putting AI into companies, and that approach should be you put really small models that companies can run themselves in place. And you can run Cohere's models on 2 NVIDIA chips. And companies are seeing fantastic results out of those small model, 'cause I'll just give you an example, like, when we're driving a car down the road, I we do not need a a trillion parameter model. So trillion parameters means it takes in a trillion pieces of data. We don't need to know the history of the world, what's being chatted about on social media to drive a car. We need a smaller model. That smaller model can run on a much smaller footprint and smaller chips. So those moves are being made today. And what was interesting about the journal's analysis was Cohere's profit margin equals software companies' profit margins already. They're in the 65 to 70% gross margin stage, whereas Anthropic and OpenAI are in like 45%. So the point is OpenAI and Anthropic are going to be forced to move to a much more efficient business model rather than boiling the ocean. They're going to have to get more specific. When they get more specific, they get more profitable. More specific being more, smaller. It does not a lot less. It requires a lot less compute. Now, somebody still has to have the compute to train the overall models, so we can't get through that yet. You do have to train the big models to make these small models, like, work, but, so you're still gonna need massive amounts of compute done by, the OpenAIs, the Googles, the Groks, slash X, and Amazons of the world, probably. Yeah. Yeah, sure. What else are you curious about? Yeah. So heat pumps, if you put a heat pump in a house, you have added electricity to the grid because that house was typically heated either by natural gas or oil before that. And so you're adding a new element to the electrical grid that wasn't there before. It was They are more efficient for sure, but it's net new. Even if they're 90% more efficient, it's net new demand. And so it's net new demand at the grid, if that makes sense. So it's reducing net gas demand mostly, as these conversions are taking place. And they are totally more efficient, but they're drawn from a different energy source that we still need to distribute, and that's why the grid is key there. Yeah.
Was tissue data centers are four about things are over the giant. Uh, they have huge education years. Now U.S.
Yeah, 2 different things, I think, is one is, like, the non-US threat, and the second is obsolescence. And obsolescence, I think a lot about too, because as we've read about these deals, everybody's asking the question and can't quite get the answers. What's the depreciation schedule for the chips? Because these chips do have a short shelf life to do their primary thing, and then they can be used and strung together for years to do secondary things. But I'd wanna know that if I was financing one of these things either on balance sheet or off. Exactly. But that's the way Silicon Valley has kind of been organized for the past 60 years. I think we've all heard of Moore's Law. Bob Moore was one of the founders of Intel. The first 5 founders were off the charts brilliant, and one of the things that Bob studied and improved, it was that chip capacity doubled roughly 18 months at the same price. And so, uh, we've been organized around this 18-month cycle in chips forever, and that's roughly the cycle that NVIDIA is still on. And so, we have known, like, how to depreciate those chips and what kind of lifetime we get out of them. However, chips haven't sold for $90,000 historically or $120,000. So this is a way different price point and way more complicated and way different chips. But generally, we know how to do that. The thing I've worried about with obsolescence is Moore's Law translated into financial physics. And the financial physics is if I'm Intel and I make that a chip advance, or if I'm NVIDIA, I make that chip advance, I have 18 months to claim profit. The economists call that accessing rents. So I can access rents for 18 months. What I worry about on the obsolescence side is the OpenAIs and Anthropics of the world who come out with a new model every 30 days. So they only have 30 days to collect rents on the new model before it's replaced by somebody else or somebody else's. And I don't know how the financial physics of that work. And I'm very concerned about that for people who are investing in the large language foundational model companies, because I don't know how that works over time, and how you actually can get to profitability. So that's where I think a lot about my unanswered questions on obsolescence are there more than chips, to be honest. In terms of the other country risk, I've lived this. I lived in China 1 week a month for a year and a half. I got this crazy challenge from Elon. We were assessing where we could go. We at the time had one factory in California. We're shipping all over the world from that one factory. And he said, "Where should we go next?" I said, "Let's go to the biggest car market in the world." The US is about a 15 million, 16 million unit new car market every year. China's 35 million. So more than twice as big. So I said, let's go to China. Elon said, "Okay, I have a challenge for you. Set us up so we're the first company in history to not have a full JV with the Chinese government, meaning we don't share economics." I said, "Well, if we don't share economics, how are we going to get all their subsidies? Because that's how you kind of get an advantage by being in China." And we managed to do that, but it took me a week, a month for about a year and a half to negotiate that with the Chinese, and we were able to negotiate it, and that's something Apple doesn't have, Google doesn't have, GM doesn't have, Procter & Gamble, nobody has that. Tesla's the only one. And what I learned during my time on the ground in China was how powerful their commitment to engineering is. They produce, on purpose, 27 million engineers a year. That's compared to about 1 million in the US. Those 27 million new engineers work what's called on a 996 schedule. So the culture in China is to work from 9 a.m. to 9 p.m. 6 days a week. So there are more of them working harder than we're working. And they have this mantra that kind of describes their whole system. They're very competitive, and so they would say to me, just to poke me, they would say, "Your country's run by lawyers, ours is run by engineers. Who do you think's going to win?" And they've got this commitment to winning the AI race right now, and they're pouring serious amounts of their national resources into that in talent and treasure. But it's a national commitment. So I do worry about what that means in the long run, because AI is not a winner-take-all race, but it's going to be a pretty crucial race to either be winning or right next to your competitor. Because militarily, if your competitor is a 10% more proficient at it than you are, that military wins. So it's absolutely crucial for us. And China has, with the chip controls, et cetera, has proven to be very effective. And DeepSeek showed us this. They're very effective at the software side. They're very effective at the hardware side. Because they've got these brilliant engineers that are working really hard. And the rap against them that they're not creative and they can't invent is absolutely false. They are inventing and creating faster than we are now. And you probably see this. 2/3 of the world's patents in AI were filed last year in China. 2/3 of the published white papers in academia were published from China. So this is a race where they're actually ahead of us on the creativity curve too, and it's something I do worry a lot about. And so we say with our approach is you can't be politically convicted around this. You need to have exposure to the profit pools that this dynamic is creating, not just here in the U.S. but internationally. So that may be more than you're asking, but I do think those two questions on obsolescence and China are really important. Yeah.
You worry about obsolescence and visible ASN. Thing become more visible. You go, oh, you worry of that in the future.
I think the arguments that people who are in this, like they're on our investment committee, is we may need less compute, but the demand for the compute is almost insatiable. So even though the demand, say, per token goes down right now, so token is an answer that comes out of the machine. The demand per token, or the cost per token may come down, the compute needed per token may come down, but the demand for tokens is going up. And here's an example of that. As cars over the next 5 to 10 years become autonomous, I think we're going to have a flip phone to iPhone moment, where if a car for the same price can be your chauffeur, you're going to choose that car. Because you can sit in the back, do the work that you want to do. You don't have to worry about traffic, and it's safer. And for the same price, most people would choose a chauffeured car. And so that means that we're probably going to go through this moment where the equivalent of Nokia, Motorola, and BlackBerry goes to zero. And that's where there's real obsolescence happening. But when that happens, the demand for compute kind of is skyrocketing, because now you have every car on the road that needs access to models and answers that can help them drive. And some of that will certainly be at the edge. It'll be in the car, but a lot of that will be in the data center. And that's the sort of thing that's driving the demand for inference computing up, which will keep the demand coming for data centers for a long time. And again, I think we're in the top half of the first inning in terms of knowing what that demand is. Yeah.
So what the top half versus you think the Mag 7
Top half of the first inning, are Mag 7 overvalued or undervalued? Man, that is a great question. On the super cycle, I think, was it Munger or Buffett who said that humans are overly optimistic in the short term and under optimistic in the long term? I think that's the case here. I don't think we understand how much demand is being created over the long term. But right now, we only have a handful of public stocks to pour that overly enthusiastic short-term energy into, and that's the Mag 7. So you would say, yeah, as other options come online in terms of other public stocks, a wise investor moves out of the high value into the low value, knowing that they're going to have upside. So I would say, over the long run, probably overvalued, because you've got a lot of up-and-comers. The next stage in compute, most people who are really deep in the problem, so the sort of the godfathers and godmothers of AI, will tell you that the current generation of models isn't going to solve the problem. You can't get to generalized AI. Certainly can't get to sentient. And most believe that quantum compute is necessary for that. And so that's going to create a whole, Apple's not in quantum, Google sort of is, Microsoft could be, NVIDIA wants to be, but these are light-based chips, not electron-based chips. So you're going to see a real shuffling as quantum starts to come online in the next 5 years, and that's going to drive a whole different rush around AI and a whole different approach. And it'll probably reshuffle the valuations, I would think, in the Mag 7. But it's hard to tell your clients I know right now, like, you don't want to be in that because they've been running up so much. But I think some of the long-term investors kind of have this right. But that is definitely the trillion-dollar question, multi-trillion-dollar question. Yeah.
So the next generation of these companies.
So that's a great question. The next generation of these companies, are they going to get public, or are they going to remain private or get gobbled up while they're private by the large publics? And I do think we're starting to see the private market say there's a limit to our capacity. In the case of OpenAI, they're basically saying we don't have the capacity. That drove OpenAI to the debt markets. The debt markets said, we only have so much capacity. You better get yourself public if you want access to more equity capital and more capital in general. And so that's why you see Anthropic and OpenAI and others starting to lay the groundwork for getting public, because there is a limit. Like you just can't raise tens of billions of dollars really every few months. Like X's burn rate is more than $1 billion a month. So Elon's got to be out continuously raising 10 to $20 billion chunks of capital, and the market's kind of signaling we're overexposed. So I do think you're going to see more of these hyperscalers turn to get public. But the flip side of that is the private markets overvalue these companies in terms of the valuation. So the entrepreneur says, I'm going to stay private as long as possible because I keep getting capital with relatively low dilution. And that's the dynamic that's keeping a lot of private companies private for a long time. If I'm Stripe, I don't have to put up all the hassle of being public, and people are constantly giving me essentially non-dilutive or very low dilutive capital. I'm going to take that for as long as I can until the market signals we don't have any more for you, and then I'll go public. So it's a very different dynamic, and it's driving the way we're thinking too, is that we're thinking about, could we get exposure to those kinds of companies for our ETF everyday investors and give them exposure while Stripe goes from 10 billion to 100 billion in value? Can you get them exposure along that curve? Because those are liquid stocks in the secondary market. They don't trade publicly, but they are very liquid, and they're not going to zero given their market positions. So they're relatively downside protected, depending on what valuation you get in at. Is that helpful? Is that interesting? Yeah. Yeah.
I wanted to kind of zoom out a little bit for, again, some of your substance are now the cost of power. From where I live at Phoenix, Arizona, a lot of people are really excited about Lynn's development, Powell Suite of Phoenix private light growth. But I know a lot of other people in flyover states who are really worried about affordability. We had few stages in that the government coefficient of our economy allows us to pick up Sears. Well, the cost of living, cost of energy have been relatively stable for incremental peaks. Cannot imagine that with the increased demand of electricity, it will exceed the growth of supply, right? By the cost of electricity for the average consumer, that there will be broad support from the citizens here in this country to sustain trying to this huge paradigm shift that you're enthusiastic for. I just don't think that we will continue to build it out at the expense of local consumers, global voting. This whole.
Yeah, that's why I think a lot of these hyperscalers are going to renewables that they own on site, because that is not adding cost. And I'll tell you, if you want to zoom way out, David, who also sits on our investment committees here, and he pointed me to an All-In podcast about a month and a half ago that Elon was on with Sachs. And Sachs was taking the administration's position that renewables aren't exciting, isn't where the future is. And Elon very effectively just dismantled Sachs's argument. And then several times he said, the sun is the biggest fusion reactor in history, and it ought to be tapped. And I thought to myself, I think I know what he's thinking. I think he is going to put small-sized data center units in orbit and power them solely with the sun. He's going to skip. This is the way he thinks. He's going to skip over the power constraint. Just like you and I, we have a debate on, oh, if we increase the grid, costs are going up like this. He's like, I'm going to skip over all that. I'm going to launch these things up like I'm launching Starlink satellites. And he's charged teams now that I had this thesis and we checked it out with people who are currently at SpaceX. Turns out that's their number one assignment. Figure out how to get small satellite refrigerator-sized data centers up in orbit where the power is free. That relieves a whole lot of constraint and puts them in a very interesting market position. So and he's not the only one thinking like that. I'm sure he's not the only one with that idea. So you're going to see all these constraints, whether it's grid constraint, the willingness of consumer to absorb cost increases constraint. You're going to see very bright minds trying to hop over those constraints because they're not solvable here in the US, at least. We have this very unique system worldwide. Almost every other developed country in the world has one utility, and that utility is responsible for generation and distribution. So that means if you want to get something done in France or Germany or China, you got a one-stop shop. In the US, we have 1,600 utilities, and not all of them have generation and not all of them have distribution. So to solve this problem, like in Phoenix versus Austin, you're talking to two very different utility companies, maybe 4, maybe 6, and you're trying to get them to do something. And most people working this problem say that is not viable. We can't count on Congress to solve that. It's too complex. It's the way our system's wired. So how about we rewire a new system? And that's what I think we're going to see. In the short term, you will see the kind of pushback that we saw in the Virginia election, which was, we don't want any more of this because our homeowner prices are going up too fast, too much. We're not going to fund this. I think that's legitimate. So you're now going to have much more creative solutions about where you're putting this stuff and how you're wiring it. And don't be surprised if 5 years from now we're in this room and we're talking about these things being up in space and the power's free. Because I think that's probably where a chunk of this is going. Yeah, there's a question right all the way in the back. I don't know the answer to that question. How many refrigerators can you put up in space? I don't know. And I don't know there are 3 different orbits that we rely on right now. I don't know which orbit they would think about putting these things in. You know what the lifespan is. There's a lot of technical problems to getting there. But what I've learned is how many of you own a Starlink Mini, the new one? Anybody here? Yeah, a few hands. The electronics to get in that were invented by the SpaceX team. None of those parts exist in the market. Everything inside that thing was invented in the last year and a half. And so if you take a team like that, can do something that can put the internet anywhere, something governments have been trying to do for 2 decades, and they can do it at 18 months, I wouldn't bet against. That's one thing I've learned. Do not bet against that maniac. He's a maniac, and he gets people to do incredible things. And so there's all kinds of constraint to this, including how much room you have up in space, but I'm guessing they're going to try to solve that. Yeah. So we then, because we're on the forefront of this, we're adjusting our weights based on this in real time. So every month we're getting together. We had this discussion actually on Friday. And I said to our investment committee, what if this stuff moves to space? Then what stocks need to be in our index? And so we're constantly adjusting weights based on real-time feedback that we're getting from practitioners. This is another thing I haven't understood why the fund industry doesn't do this. We called the people that are building AI data centers and said, would you come sit on our investment committee? We're getting real-time information. It's the kind of calls the hedge fund people make or the analysts at Fidelity make, trying to find out this stuff, and we're finding it out in real time. And we're adjusting the weights in the fund and the stocks in the fund to reflect it. And it's a little too early to invest in the space thing, but we're getting ready because that movement's going to start to take place, and now we'll monitor. Like, what advancements is SpaceX making in this field? Who else is in it? Is Blue Origin seeking this out? Is Lockheed seeking this out? Who are they going to compete with? Who are the suppliers? What are the components? All that. What's the build sheet for one of those things? What does it look like? How's it different? And so we're doing that every 30 days on our investors' behalf. All right, I'm going to sneak out of here, Adam, without getting one Elon question, which is awesome. So any other questions before we wrap up? Great. This is a lot of fun. Thanks for doing the interaction, and the VistaShares team is here if you want any more details on funds construction and fund performance and the different super cycle products that are coming next. But thanks to GTE folks for hosting this.
Thank you, John. Yeah, so there are some presentations on most of the tables. If you didn't get one, it's probably because we ran out. So just grab someone from the VistaShares team. We'll make sure to email you a copy. The version that's on the table is very deep dive compared to what even was on the screen. So it's some good research information. Thank you very much.